There we are. I see a few people are still bouncing in. Thank you for finding panel 3. Boy, that panel 2, Dwayne, I don't know, were you listening to that at all? Oh, hit your microphone.
I missed it, actually. I just ran into the office. I did miss it. Was it a good
So I don't know, crypto funding, man. It's something I hadn't heard of. I feel like I must be hiding under a rock, but pretty cool conversation.
Okay, I'll watch the replay.
Yeah, I wanted to, and I'm gonna actually have this Ed guy on my Power 30 show, so we're gonna have to. I think that'll be a good show to catch. There was a question on that last panel about cap rates for retail, so I think that's a good place where we can pick up right here because we have David Wheeler with us. So David, you want to do a quick intro of yourself and then pick up on where you think retail cap rates are, and then talk about acquisitions in this time right now.
Yeah, sure. Thanks, Todd. Appreciate the question. We, from a deal flow standpoint on retail, it's been mostly unanchored strips so far in terms of what we're seeing. There have been a few grocery anchored deals. What we're noticing is cap rates are a little higher in large part because NOIs are harder to underwrite right now, and folks are not sure if they're going to have to replace tenants or not. So we're seeing cap rates for kind of stabilized stuff that are probably 50 to 100 basis points higher, or half a point to a point higher than what they were pre-pandemic. I think there's still a lot to play out the retail space, but let me tell you a little bit about myself. I've been with the Hartman platform for about 17 and a half years. Prior to that, I was with CBRE for about 16 years. We're a Houston-based firm that invests in Texas, DFW Houston and San Antonio, about 800 million assets under management. About 2/3 of that is office. Most of the rest is shopping center. And there's a little bit of industrial on the platform. We're vertically integrated. So what I really mean by that is operationally, everything's on the platform. Our leasing team and our property management team are on the platform, help us operate these assets. And they're part of the secret sauce that we use to drive performance and maintain customer relationships. So there's a couple thousand tenants in the portfolio, about 4,500 investors. It's all the money's been raised in a pretty granular fashion from retail investors. And we've got an active fund in Fund 21 right now that's open. So we're constantly sourcing in all the markets that we're active in. On an annual basis, we review about 600 properties per year, and quickly screen that down to maybe less than 100, maybe 75 to 100 that are of interest to us, that we're more interested in evaluating. So needless to say, we see a lot come available. What we saw during the early parts of the pandemic was a real quick slowdown. I heard Chris Ludeman with CBRE talking about deal flow this morning, and this kind of confirms what we saw. They saw offerings go down to less than a third right after the shutdown, but things have trended back. Deal flow overall is probably about 75% of pre-pandemic in terms of what we're seeing come available on the market. It doesn't look exactly the same. There's some pretty significant differences in what we're seeing. From an office standpoint, it tends to be either a core asset with a long-term tenant in place that would be desirable to an institution, or it tends to be brand new, relatively new assets that become distressed recently. So that's only about 50% of the deal flow probably that we saw pre-pandemic. On the industrial side, we're tracking enormous volume increases. What you'll hear if you talk to anybody that's active in the industrial space is business activity is well above what it was pre-pandemic. Institutional investors are driving that. They all want to make and place their allocations into industrial as quick as possible. So cap rates have not only reached pre-pandemic levels, they've started to compress from there. So if you were looking at 5 to 6 cap rates pre-pandemic, you might be looking at sub 5 in some cases. But right now we're tracking almost 20 portfolios or individual offerings that have come available in this region in the last 8 to 10 weeks. And it's over $600 million in assets. And what we understand is it's really the institutional capital that's driving that demand right now. On the shopping center side, I think folks are kind of hitting the pause button. I know that some folks are interacting with their servicer, trying to get some relief, or they have gotten some relief. They're trying to underwrite their NOI. They're trying to figure out if they can sell, or if they just need to refinance, or if they just need to hold on. So the distress hasn't completely baked through the system yet. CMBS delinquencies have reached 10% plus. That's concentrated in hotel and shopping center for the most part. There's a little bit in office, but most of it's hotel and shopping centers. So it's going to be a little bit of time for those shopping centers that are going to come available as a result of distress to actually bake through the system, to have an underwritable NOI, and for people to understand coming out of this crisis what they've got. So that's kind of my comments generally on deal flow. If you've got any questions for me, I'd love to answer them.
Yeah, I don't understand the underwritable NOI. I totally get the core assets, like the one Dwayne's got right now. A single tenant, good tenant, you can get your arms around it, you can understand it. A retail strip center, David, are you even looking at something where there's questionable rent payments?
Yeah, so you're having to make conservative assumptions. You're looking at what kind of collections folks are getting in their shopping centers right now. And then you're also trying to figure out, am I just going to treat that as a vacancy? There are going to be some of those tenants that make it on the backside. And what's the duration for that distress? But our shop, we operate over a dozen shopping centers. So we're actually seeing surprisingly good new tenant activity. And there are definitely some winners in the shopping center space. I think everybody knows the losers are folks that are more entertainment oriented, or maybe the bars and other folks who can't be open now or can't be open at meaningful levels. But then again, there are other tenants, home improvement space, grocery center space, that are doing exceptionally well, traffic volumes. So a lot of folks are trying to position themselves for coming out of the pandemic, get their business open and operating, maybe with some free rent for a few months. And so there is leasing activity out there, but it is a challenge to underwrite right now. It's a very big challenge. You got to look at age receivable. You got to see who's paying rent. You got to figure out if those tenants that are struggling are going to make it.
David,
thanks for following up on that. Yeah, go ahead, Dwayne. I want to do intros quick so everybody knows who Dwayne Lund is, but shoot,
okay.
Go ahead.
Intros first. I was going to ask David a question about retail, but Todd, I'll do the intro of myself. My name's Dwayne Lund. In Minneapolis, I'm the CEO of NEI Legacy. If you're familiar with the NEI global brand, we run the state of Minnesota. I've known Todd for almost 25 years. Like Todd, I was a CPA back in the 80s. Been in the REIT industry for about 15 years, mostly in the 90s and early 2000s. And then for the better part of the last 15 years, been involved in more of the private sector, but really focused on sponsoring tax deferred deals and tax incentivized deals. And I think that's why I'm going to be talking about DSTs today. But that's my background. NEI Legacy is a brokerage firm. We property manage and have investment sales here in Minnesota. And then we work the NEI Global National Network with our DST platform. But David, I did have a question for you on the retail side, because we do sponsor retail triple net leases. And it seems to me there's been this bifurcation between essential real estate, kind of a new term, and non-essential. And at least from our desk, the essential category cap rates, it actually appears they've gone down the last 3 or 4 months. And if you're in that non-essential category, probably throw the rule book out. But curious what you're seeing down in Texas. If you look at the essential category, food, pharmacy, fuel, and what you see as cap rate trends in Texas.
Yeah, definitely. So fast food is, as you probably know, is doing really well. The folks are driving a lot of traffic through their drive-throughs, and they're not having to spend as much money in their dining rooms. Food is overall doing really well. Of course, restaurants are scratching their way back, but when it comes to grocery sales, they're seeing really excellent volumes right now. Of course, I don't think the gas operators are doing quite as well as they will be doing moving forward. You've got reduced traffic levels on the highways, so but they are essential, and I think folks recognize that they are, and that we're going to need all that infrastructure that they provide and operational capability that they provide, moving forward. It is interesting to see that towns like DFW, Houston, San Antonio, places in Texas are really benefiting relative to the rest of the nation because we're car towns. Folks they're a little afraid of mass transit, as they should be, and therefore those towns where folks are getting around, whether it be to get essentials or to get to work via car or automobile, are seeing more activity. I mean, DFW is leading the nation in office utilization right now. So, those kinds of things they're meaningful.
Well, thanks for wrapping up that second panel. That was fantastic, and talking acquisitions. I'm sure we'll get back to talking about current acquisition of product, but we're already 14 minutes in. We haven't introduced Cindy. So I'm going to let you kind of introduce yourself and what you're up to, and then we'll segue into some more stuff and talk real estate deals.
Hello, everybody. Thanks for having me. My name is Cindy Pham. I am the Division Manager of Asset Preservation. We're a leading national qualified intermediary for 1031 exchanges. We are a wholly owned subsidiary of Stewart Title. I cover South Texas and Louisiana. Do you want me to get into, the 1031 stuff, or are we talking about something else? Or are we moving on to something else right now?
Yeah, let's talk 1031 just for a minute, because we promised everybody we would in the agenda. So give us kind of, I mean, 1031s are still happening, right? They're hot.
Yeah, absolutely.
Stuff's going on. So just give us an update on that, and then we'll kind of segue, I think, into talking Delaware statutory trusts and alternative options to the traditional 1031 everybody's used to.
All right, so the 1031 exchange is also known as a like-kind exchange. It's the tax code that allows investors to defer their capital gain taxes when they reinvest into another property or a trade or a business. And most people, if you're familiar with 1031 exchanges, the most common type of exchange is when the taxpayer is selling their relinquished property and then they're buying the replacement property. There are other types of exchanges that we've been seeing, or I've been getting a lot of calls lately. They're more complicated exchanges. They're more strategic. We do them under parking arrangements where the qualified intermediary will have to take park title on these projects, such as the reverse exchange, where we purchase the replacement property first, and then you have 180 days to sell your relinquished property. We're seeing this happen with the off-market properties. Another exchange is going to be the improvement exchange or the build-to-suit. So instead of they're using the client doing a 1031 exchange, they want to use the proceeds to buy the property and build the building, or do a build-to-suit or a major capital renovation. And so you still have 180 days to complete the exchange, which means you don't have to complete the building. You're just going to complete pretty much the work that you identified that you're going to do and use all the exchange proceeds. Then we'll close out the exchange. So, and we can combine those exchanges as well. So we'll do like a reverse improvement exchange. I have been getting a lot of people asking me about doing an exchange on property that they own. Is that possible? Well, technically you can't do an exchange with property you already own because that's not an exchange. But however, if you plan it, you properly structure it, there's a way to structure that type of exchange. We do it through a leasehold improvement exchange. That's with the leasehold interest that's going into the like kind. So like kind, when you're doing an exchange, that's going to be a very broad term for the IRS. Typically it's going to be any type of investment property or property of a trade or business. So you can go from a single family rent home, vacation home, commercial property, land. Leasehold interest, that's considered like kind. So any type of, you can exchange into a lease that's more than 30 years. And oil and gas, royalty rights, those are all real property that's considered like kind. And going into the GST, fractional ownership is considered like kind. So Revenue Procedure 2004-86, that created kind of the fractional, the DST, the Delaware Statutory Trust. So The fractional ownership is actually owning an interest or a slice of an institutional grade asset. And we used to do them, it was more popular back then with TICs, and then the TICs kind of went away. The DST kind of replaced it. And then Dwayne's going to talk a little bit more about it, but this is the GST is sometimes called a beneficial interest in a trust. Typically, that's considered personal property. However, this revenue procedure made this an exception. So it's kind of like a hybrid between like a security. It's going to be regulated under the securities federal law, but it's also treated as an ownership of real property. So you can do a 1031 exchange into it.
Awesome. I'm getting Dwayne's PowerPoint teed up here real quick. But Dwayne, do you want to just give us an overview of, okay, I think Cindy, you made a comment on our prep call that in Texas, not a lot of people are doing DSTs, but this is a common exchange tool, right? And you can exchange part of your proceeds or all of your proceeds, but it's a way to sort of fill out exchanges commonly,
Right.
or you find a property you really like. And so I've asked Dwayne to show one of his. Once I get it up, I don't want this to turn into a commercial, but I think having a real live project to kind of look at is a good way to talk about this. But Dwayne, just want to give us the basics, and then I'm going to try to get this.
Yeah. So as Cindy mentioned, the Delaware Statutory Trust form of ownership, that legal entity form of ownership, has been around for centuries, candidly. But it was in 2004 that Inland, a group out of Chicago, put forth a request for an opinion on the structure of a DST and whether the beneficial interest, as they're known, I call them shares, but the beneficial interest in the trust would be deemed real property under the code. And that's the Rev ruling that Cindy mentioned. That happened in 2004. So for the first time, one could do an exchange from a real property, or sell a property, and then take a beneficial interest in a trust, whether it was 1 share or 1,000 shares in that trust, and that beneficial interest would qualify, provided the sponsor of the deal structured the deal pursuant to that Rev ruling. So yeah, it started in 2004. We at NEI, we did the first DST in the state of Minnesota, and it was an interesting, offering the first time we did it. Now I come, as Todd knows, from the REIT sector, and I was involved in several public REITs in Texas. Probably First Industrial is the most recognizable name. I'm one of 5 guys that formed that back in '94. But when I looked at DSTs as a form of ownership for 1031s, it has some of the similarities to an umbrella partnership that we used to use for our REITs, in that you can take shares and have some tax benefits attached to it. And the DST market, now I didn't go all the way back to the Genesis 2004, because from 2004 to 2010, I'm looking at this slide, for the most part, DSTs were not used. Instead, there was a different technique. A lot of people used LLCs or tenant in common, but it became popular shortly after the Great Recession, and people started using the DSTs. And I will tell you, we've done a little over $1 billion of tax deferred deals here at NEI, going back over the last 15 years. And the DST is the only legal structure we use. And as Todd knows, we've also used the DST form of ownership for non-1031 deals. In fact, we've used DSTs for an opportunity zone fund that we raised, and we've used a DST form of ownership for a bonus depreciation syndicate. But anyway, just to kind of give the audience an idea of how large the sector is, because in some ways you'll talk to a real estate professional, they've heard of DSTs. Others will say, I've never heard of it, Dwayne. What's it really all about? But look at the numbers. And these are the trend lines for DST equity that has been raised. And this is purely 1031 equity. So 2019, the last reporting year, $3.5 billion of equity was placed in 1031 DSTs. And most of those DSTs are levered 50%, some as high as 60%, but even using just a conservative 50% number, you'll see this is a $7 billion industry. And the trend line in 2020, and I know David has done some DSTs, 2020 was off to an awesome start for DST offerings. And then of course, COVID hit. But here you can kind of see how popular the technique has become in the 1031 community. And those that offer interest in DSTs are known as sponsors, which is what we are. And on any given day, Mountain Dale kind of tracks us nationally. There's 30 to 40 active sponsors in the country. We're one of the few that has a national footprint. Names like Inland and Pasco are names you maybe see in the space. But this is the equity slide. And then Todd, if you can go to the next slide, this is to give the group or the audience a feel for where the money's being placed. And you can see by stats, this is last year's numbers, multifamily has dominated the DST sector. Okay, a lot of the offerings that are out there in that multifamily space, partly because the average investor in a DST is typically somewhere between, they're all accredited, but typically between $250 and maybe $1 million. And many of them are very, very comfortable owning multifamily because that happens to be the sector they sold product in. But so here's the breakdown. And, you know, as Cindy mentioned, energy, the oil and gas space, some of those offerings are in a DST structure. You can see hospitality, senior housing. Our company, we focus on industrial and then triple net, and most of our triple net happens to be retail. But again, here you can just get a feel for the size of the sector and where the money's being placed by product type. So that's the big picture overview, Todd, of what's kind of happening nationally.
What's the minimum investment? So when I do a 1031 exchange for a client, sometimes they, I've got some clients that don't want to manage real estate. They don't want to get into real estate. So that's they don't want to pay the taxes. They don't want to manage real estate and deal with property managers. They don't want to deal with any of owning property. So I always recommend them to a DST as a possible solution because, you know, I call it, you get mailbox money as an income stream. You know, sometimes I have clients that have replacement properties, but they have a boot. They have extra money that they have not found replacement property for. So sometimes I have, you know, clients with a couple $100,000 in boot money that they need to reinvest. And I'll send that over to a DST as well. So what is the typical investment that a DST requires?
Good question, Cindy. And I think it depends on the sponsor, but the industry standard tends to be a $50,000 to $100,000 minimum on the offerings that I've seen around the country. And again, the offerings for the most part have been limited to accredited investors. And I think, as you mentioned, maybe Todd mentioned, most of the offerings are actually securitized offerings. They're Reg D filings, full PPM offerings, and the product is sold as a security to broker-dealer channels. And yeah, I've seen minimums, you know, I think I've seen some at 25, Cindy, but for the most part, 50 to 100. Now our program's a little bit unique, and Todd knows this because he's seen several of my deals. We do as many private client DSTs as we do public, what I call more public offering DSTs. We have a lot of DSTs with less than 5 investors, very specific to a few clients that want to get in the deal, relationships that we already have, and those are not securitized offerings. They're real estate transactions from our side, but it really has been used by family offices as a succession tool, candidly, where they're exchanging into the DST, taking shares in the DST, and then actually allocating the shares to their heirs over time, obviously when they get basis step up. But it's a pretty intriguing succession tool if you ultimately want to hand those shares off to your heirs. But anyway, long answer to your question, 50 to 100. We've had several deals there. It's 250 minimums, a large deal we just closed, but usually it's 50 to 100, provided they're accredited.
Yeah, I miss the estate planning days. That stuff's like putting a puzzle together that has weird shaped pieces, like one of those 3D puzzles. It's not normal.
Yeah. Well, it's a case study where we're dealing with a family that is selling an asset they've owned for over 40 years. It'll be a little over a $30 million transaction, and it's still owned by, you know, one individual, grandpa they call him, but, you know, we're setting it up in a DST because his heirs ultimately will get the shares, and he wants to give his heirs the independent decision whether they want to sell their shares or not. You can never do that in an LLC. So it's a pretty compelling way to structure a DST estate for a family.
Hey, when Grandpa's got a $30 million asset, you can be called anything he wants.
So
David, you're not a stranger to DST.
Go ahead.
You're a long-time company with long-time holdings, but this isn't news to you.
No, it's not. We're on our third DST, are offering our third DST. It does have a minimum of $25,000, and it's a great tool for somebody who has a leftover piece, like Cindy was talking about, or somebody who might want to spread a requirement across a number of opportunities, or even concentrate the requirement if it's not too large into one deal. So. We've got probably $7 million worth of availability left on one of ours, but there tend to be great options for folks in the 1031 requirement space, like Cindy said, that don't want to own and operate their own assets directly. So.
All right, Dwayne, do you mind? I don't want this to turn into a commercial, but I really want to go through this because I think it helps people see what they're looking at. So you have a project. Is it still available?
Restoration.
Yeah.
Let's just go. You want to do that
Throw
slide?
it on there?
Yeah. Happy to talk about this one. This is a pretty unique transaction. This is a DST that we just went live about a week ago. If anyone's been to the Restoration Hardware in Austin, which is a 60,000 square foot gallery, the one that we own here in Edina, Minnesota, is almost identical. This is 58,000 square feet. I think the one in Houston over at the gallery at Highland Village, that's about 30,000 square feet. Yeah, this was a unique deal, but it gives you an example of the type of deals you'll find in DSTs. This one, we were under contract to acquire this directly from Restoration Hardware pre-COVID, and we're scheduled to close in March when COVID hit, so we had to put the brakes on and kind of rethink it a little bit. This ended up being then a restructured purchase agreement, but we closed in July with Restoration Hardware. They signed a 20-year lease with our group, our DST, and it's a pretty unique lease, Todd, because it's an absolute triple net lease. They're responsible for CapEx, and RH, if you follow them, if you're not in the stock, it's an interesting stock play. Their stock is up 25% this morning. Their earnings were released last night, and their stock has gone up fourfold from their bottom COVID. So they're about a $7.5 billion market cap company. So good, strong credit. They fall into somewhere between essential and non-essential, but we got so comfortable with their credit because they're publicly traded. And yeah, Todd, so this is a deal that is out there where it's about you can see a $28.6 million deal with about $12 million of DST equity, most of which is already committed. But there still is some room in this deal. I know Cindy has a client that's looking at it. But again, to kind of give the DST flavor to it, 12 million shares, each share is $1,000 a piece, and this one's $50,000 minimum. But the beauty of it at the back end for 1031 investors coming in, they'll have a share in the deal, or they can buy 1,000 shares and then they can hand those off to their heirs. Now, Todd, this one's also unique. I know you and I did a separate seminar on bonus depreciation. This property here is chuck and full of personal property. So we do a cost segregation study, if you're familiar with those, and we'll delineate between land, real, and personal. And on this deal, our cost segregation study came in around $12 million. So we'll write off $12 million of this the first year, and that tax benefit will go on to our investors, some of whom have basis, and they can use that to offset their distributions. So pretty unique deal because we get the 100% write-off and bonus depreciation on this deal on top of it being a 1031 deal. So yeah, Todd, this is one, if you went to, again, I'm not trying to be a commercial, but legacyofferings.com, that's where all our offerings are located. And that's where you can get more information on deals like this and other deals that we have in our pipeline.
So investments in DSTs are typically passive ownership. There's no voting rights for the investors. Typically, how long are you holding on to these assets?
Well, two questions. On the voting rights, you're correct. Typically, everyone has a vote, so there's 12,000 votes, for example, on that deal. And then we have supermajority provisions, typically somewhere between 75 and 80% for a major transaction like a sale or a refinance. And then as far as holding periods, if you look at most offerings, the sponsor, as we're known, will put in, we anticipate a 10-year hold. There's no usually definitive time period that anyone's going to hold a property, but that typically is how it reads because it tends to match the debt. So our debt on this property happens to be 10 years. So we suggest it's a 10-year hold because something has to happen between now and then. But typically these deals are 10-year. Now, we did an industrial DST, which is our other product category. We closed that in February of 18, and we're already selling it because, well, as David knows, the industrial market is still really hot. In fact, those cap rates are down, and so we got a compelling offer on that deal, and we're actually selling it. So,
Dwayne, are you using CMBS debt on your?
Not anymore. How about that? We use CMBS. We went long on it back in the day. Back in the 90s, we used it on our REITs. In fact, we used it in the early 2000s, and I call it faceless debt, David. We decided we're not going to touch that anymore. We actually use, for the most part, a network of national and community banks.
Interesting.
Yeah. Which creates some interesting carve-out issues for us, but, at least we have a face when and if we need to talk to our lender, because we found that CMBS debt, and I get it, it's cheap debt, but we had a very difficult time restructuring CMBS debt in our offerings, back when things went bad in 8 and 9 and 10 for all of us.
That's a great question. Right. Any investment vehicle is not perfect for everybody or exactly what you want it to be, right? There's gives and takes and ebbs and flows to the market. So let's just talk real estate again for a second, outside of DSTs, outside of 1031s. If you have, I'm going to bring it into 1031s. If you have 1031 equity, what types of real estate are you looking at? What's the preferred? And are there other opportunities out there to maybe pick up value add or another type of real estate that might be compelling? David, you want to go into, what acquisitions you're looking at right now?
So we're usually focused on value add opportunities, but we're also looking at kind of core plus and opportunistic situations as well. And we do on occasion compete with 1031s, not usually though, because most of the 1031s aren't interested in handling kind of challenging situations or doing heavy lifting on the kind of value add and opportunistic things that we acquire. So when you've got in-house operational staff to help make those assets work, like we do, it's a no-brainer to acquire, a low LTV and put a whole lot of effort and time into turning these things around. I think that can be intimidating for some 1031 requirements unless a operator or a company is set up to do that, and they're the ones with the 1031 requirements. So they are out there if you're interested in kind of busted properties or turnaround properties. But just be aware that it takes a whole lot of effort and investment and time and more of a operating landlord type mindset to make those work.
But you're still doing it. I got to tell you, in my history in real estate, and right now is the time to start looking at value add, but I'd be scared to death. So how do you get your head around that? What makes you comfortable?
Well, what makes us comfortable is a number of things. One is we keep leverage low. So we're looking at 50% loan to cost when we acquire, sometimes even lower if the property won't underwrite at that. And the other is the internal operational capabilities. So we're doing a lot of backyard investing. We're buying in markets that we know well. We're acquiring properties that we're familiar with. So that gives us great comfort that we can continue to drive user activity and leasing activity to our properties, that we know how to handle the vacancies, create the move-in ready suites or the white box suites that work for retail tenants. So it's really operational capability that drives our confidence in acquiring assets that require turnaround. And we've got 175 folks on the platform, and more than half of those are devoted to the operational staff, and they're really good at what they do. So that's what gives us confidence moving forward.
Dwayne, so what are you looking at? If you obviously are looking forward 6-12 months, where's your pipeline? What's filling your pipeline today?
Yeah, well, an interesting observation, Todd, you and I have talked about on other panels, is actually the profile of the 1031 investor almost as much as the properties they want to acquire. And I will say this, and I'm a baby boomer as well, the industry is retiring. And it's interesting to me how many individual investors, because I was a product of the 80s and bought properties in the 80s and 90s, and we all reach a point when we just say we're done. And it's interesting to me, the investors coming into our program, these are individuals, many of whom have had relationships for years. There's no way they ever would have bought a single tenant, net leased, long-term lease Walgreens. And now they're looking at that sort of stuff for the first time because they're just done. And I appreciate what David said about value add, because I was with the Scheidler Group for the longest time, and Jay Scheidler and the Scheidler Group incubated a lot of these REITs. We were value add guys. That's all we did. And candidly, Todd, we're not looking at any of that. It's a different risk scale, a risk profile. We're looking for leases. Sometimes I almost hate to say it, we buy leases more than we buy buildings. If I can get comfortable with a lease and the credit behind the lease, and it's a good location, that candidly is the demand we're hearing from our clients. And I'll be interested to see what Cindy says, because she sees the money first. But we get more and more calls from individuals, Todd, that finally say, Dwayne, what do you got in that net lease category? 10 years plus lease term. And by the way, I'd like to be in a no tax state. I want to be in Texas, Florida, Tennessee, Nevada. It's crazy how many deals we're looking for in those states, including Texas, which is one reason I'm on this panel. We're for the first time moving a lot of money out of the Midwest in these high tax states into low tax states. So what am I looking for, Todd? My clients, my demand right now is for passive long-term leases in the desert and no tax states. And that's what we're looking at for the most part. I don't know, Cindy, what you're seeing with your clients, but that's what we're seeing. We're just seeing a whole wave of individuals retiring from the sector, and they just want to be done. They're done.
For sure. I get a lot of California into Texas. It's just because their taxes are so high. They've got the state income tax. I always say that the Golden State, they're like the golden child. They're very aggressive on coming after taxpayers. And so even with a 1031 exchange, if you're from California, have a property in California, you've got to specifically file a tax form with California every year, just so they can keep track of your taxes. Because if you get rid of that property and you don't do another 1031, they're coming after you for your taxes. So we see a lot of out of state coming into Texas.
Yeah, and
I imagine there's a lot of Teslas in Texas right now with California plates on them, don't you think? Hey, go ahead, Dwayne.
Yeah, well, in Todd, you know this here in Minnesota, and I think it's happened in Illinois, and a lot of the high tax states on the East Coast. You know, you have to take your tax basis with you. I have a lot of buddies that they're moving to Florida, they're moving to Nevada, they're moving to Arizona. But if your building is still in Minnesota, or if it's in Illinois, your tax base lives in that state. So in the simplest form, they're changing their residency because of lifestyle changes, but they want to take their basis with them. We just helped Cindy, ironically, a family from California move into a property in Jacksonville, Florida for that specific reason. They want to get their basis out of California. And whether it's right or wrong, you'll hear people say it like Barry Sternlicht, buildings don't vote. So buildings are easy to tax. And yeah, I think there are those that want to get their basis out of what they believe are going to be high tax states going forward.
Buildings don't vote. Boy, if they could. Right now, we could use some of that. Cindy, so you see the 1031 forms though, right? So people are identifying properties. Would you agree with Dwayne and David as to where their interests are and what they're kind of looking at?
I don't really get into that, because in my role, I just kind of educate, then I go through the process. But as far as going into the documents, and actually when they identify, people will call me as far as what they can do and what are their options, and way before they start, because 1031 is strategic, right? So you're not just, you have a timeline. You have 180 days to replace your property, but you have 45 days to identify. So a lot of it, people are not making last minute decisions on identifying. They're calling way ahead, and what can I do? What can I buy? I get a lot of land, buying into property. And right now I'm getting a lot of call regarding improvements, putting money in improvements, just because I think there's the fear with COVID. It slowed down a little bit for me at the very beginning of COVID. It's just picked up this summer. It picked up June, it got busy July. Last month was very busy, but I'm getting a lot of those improvement calls instead of the clients wanting to buy a replacement property. They want to put the money in building it, just because I think there's fear of what's available or what's going on with the market and the uncertainty of COVID. And then of course I get a lot of people that I'm just scared of with the cycle. We're another cycle right now. And so they're just in fear of what's happening right now. And what can I do? What can I invest in? But I don't really want to, I'm really unsure about managing and owning real estate. So it's definitely, I have probably been referring my deals to financial advisors, deal with USPs more now than I have in the past.
Interesting. Well, there's a question in our chat room, if anybody noticed it, about politics. I don't know if I want to touch it, but we probably should because it's fun. So what happens, I know that Biden's talking about getting rid of 1031. Obviously, Bernie Sanders talked a lot about it. I can make a quick plug. October 22nd, we're having a national net lease conference in Minneapolis. Try to get all the net lease folks together. We're having a luncheon to talk about what happens if 1031 goes away. And I think the question is also eliminates or raises capital gains rates. So what's the future look like for 1031s? Does anybody want to touch that?
Well, the tax code's been around since 1921. So if they get rid of the 1031 exchange, it's been a tax code for 99 years. By next year, we hit our 100-year anniversary for 1031s. So, gosh, I mean, the future is unknown. If Biden wins and the Democrats take over the Senate, I hope not. But what I tell people is that a 1031 exchange, it's not only Republicans that are using it. Okay, Democrats also do 1030. It benefits everybody. Tell me, the Democrats, if someone, that's a Democrat that's not using a 1031 exchange. A lot of my clients that I'm talking to, they're Democrats. So it's a tax code that benefits anyone and everyone, and it doesn't discriminate what side of the politics you are. And so, all I can say is I hope not. It's something that's proposed, but not necessarily that's gone. I mean, there's a lot of Democrats that are pro 1031 exchanges, and we use my boss, who is the president of the FEA, who governs the 1031 exchange. I mean, they're doing seminars and talks and lectures to the Democrats all the time now, just to educate them on the 1031. So right now we're just kind of trying to educate everybody about 1031 exchanges. So hopefully it doesn't go away.
Todd, I'll just add a little color, and I think we've talked about it other panels, but there's white papers out there that profiles this whole 1031 industry and the tax savings versus the tax benefits. And what everyone does forget is yes, there's some taxpayer that's deferring the taxes, but because a deal got done, guess what? Cindy got paid, an attorney got paid and paid taxes. There's someone that bought the property and hired a lender, and that lender got some fees, and guess what? They paid taxes. And that I've seen white papers that for every transaction in the 1031 market, if you look at the taxpayer side of it and all the professionals that touched that deal and paid taxes, including a broker that got a fee, it's almost a net zero at the end of the day, because you're wiping out, and Cindy hit it head on, this is a 100-year-old industry, but you're going to wipe out a service sector that pays a lot of taxes if you take away 1031 exchanges. And I've seen those white papers. I think NAR did a white paper back in the day, but hopefully they'll look at both sides of the transactions. A lot of taxpayers are tied to the 1031 industry as well.
Yeah,
ultimately, if you get rid of 1031 exchanges, it means less deals. Okay, so title doesn't do as many deals, brokers are not doing as many deals. 1031 exchange, it's all investment property. So even your rent homes, people that invest in rent homes, I mean, it goes down to the mortgage company, goes to the handyman. So at the end of the day, depends on, it doesn't matter what politics that you side on, it's job growth. If you get rid of the whole industry, that's a lot of jobs that you're cutting out. So it came up in tax reform 2017. We were able to save 1031 exchange. We got rid of personal property because prior to 2018, we did exchanges on, private jets, collectible artwork on personal property. And since 2018, it's only been real property or property of a trade or business. So, we saved it because of that, because it's job growth, it's job opportunity for a lot of different industries. So again, it helps our economy. It contributes to our economy.
All right. So I've sat through 3 panels now this morning, and I love it because nobody's really talked COVID, and I appreciate that. I mean, people talk about the environment we're in or the COVID environment. Nobody's talked about, everybody's tired of talking about it. But where does our 1031 industry headed? Is it changing? When do we get out of this COVID? Does it change then? Is it so hot right now that who cares? Let's just keep rocking. What are all of your thoughts on emerging from this mess? When do we emerge, and what does it look like? What's the landscape?
As far as for me, right when it hit, it slowed down, but as of, it started picking up around June. I had a very busy July, August, and I see it staying busy. But then again, with the 1031, it's a broad investment property portfolio of what you can buy and sell. I do see it. I've seen it slow down a little bit on the commercial side, just because of the lending side. But we're still busy. We're still doing deals. I've had a couple commercial deals just closed recently, so the deals are still happening. So I see it continuing to grow and transactions still moving.
Yeah, Todd, I'd echo the same. And I'll speak on kind of the NEI side, the brokerage side of our business. Obviously, everyone put the brakes on, and it was very defensive for almost 4 months. We finally came out, closed that RH deal, and I will say transactions are picking up. The CPA in me will say this, most of us file our tax returns around October 15th, and there's some interesting provision in that CARES Act that was passed, and those tax provisions and benefits expire 12/31. I actually think the fourth quarter of this year is going to be extremely exciting from a tax incentive and tax strategy side for the real estate community and profession because of what expires on 12/31. So I think the bulls are out, Todd. I feel pretty good about business right now. It's offensive, and the defensive side was kind of boring. So, but the bulls are running again, I think.
Well, Dwayne, you and I went through 2 recessions together. So they were, from real estate, got beat up pretty bad in the last one. I mean, I don't think it's ever been beat up any worse, even in '86. But boy, it looks like we're gonna ride this right on out.
Well, yeah, we talked. I mean, this is a different type of black swan. Those black swans we had in the late '80s, and then of course that .com bubble, and that was a black swan, and that black swan we had in 2009 and 10. But this one's different because it's health related. But I don't know. Hopefully, the black swan goes back to the marsh it came from, and we'll be okay. But control the controllables. It's all we can do, and I think our shop has done a good job controlling the controllables. That's all we can do.
Go back to the black marsh. We got to find that and shut it down.
Yeah.
David, what are your thoughts on moving forward out of this?
Yeah, I'm hearing vaccine announcements coming in a month or two, expecting widely available, vaccine availability probably first quarter, coupled with low interest rates, a rapidly recovering economy. I think next year is going to be very interesting. I think it'll be lots of really good business activity. I'm pretty optimistic about our trajectory next year, and then probably by the end of the year reaching pre-pandemic business activity levels across the economy. So I'm really wildly optimistic about what's going to happen next year. I think it's going to be great.
Is that kind of consensus at your firm too? Everybody's sort of feeling like let's get ready for things to happen in 21.
Yeah, I think so. I think they all know there's a number of tenants that have challenges still to work through. But in the real estate business in particular, if you look at the low interest rates and the low debt costs that are already available for core assets, and likely spreads coming down even further, for other more riskier assets, as we move forward. I mean, the Fed has just really done a tremendous job of keeping capital availability high through this crisis, and that's going to play big dividends next year. It's already played, big dividends this year, and I think it's going to continue to be just incredible. So we're at the zero bound on a number of rates. LIBOR's low, Treasuries are low. Some of the spreads are still a little higher than you'd like to see for, more riskier assets, but I think they're going to come in dramatically over the next six to 12 months. And you'll see some pretty significant lift next year. I really do. I think, from an unemployment standpoint, I think we'll be down around 8 by year end. I think we're getting close to that already, maybe even lower. And I think by next year, end of next year, we'll be, mid single digits, probably not back down to the 4 by the end of the year. But I think it could be, 5 or so by the end of next year. So I think the future's bright. I really do. Folks are ready to get back to the office. Work from home worked for many reasons. One, because we didn't have an alternative. 2, because folks were working on reduced business activities levels from the house. But I think, a number of folks are ready to get back and collaborate in person and go to professional events and make things happen. So.
Events, man. I can't wait for the event business to come back. I'm glad you addressed the elephant in the room, though. Jobs, interest rate. The Fed's kept no secret that they're going to keep interest rates low for a long time.
Right.
Alan Greenspan used to be really coy. They're not coy anymore. Like, we're going to keep interest rates low for foreseeable future, down to 0.
And they're even saying they're going to allow the overshoot on inflation. So they've basically indicated it's going to be dovish for quite a while.
Yeah, it's a good thing. Okay, we are sort of, we got 5 minutes left. We zigzagged around on a topic, which I tend to do because I'm curious about a lot of things, but I want to give everybody a chance. We'll start with Dwayne. Is there anything that we didn't talk about, or do you want to recap anything that I might have missed? So you got a couple minutes here to sort of ad lib and pick up on any missed subjects.
Well, thanks, Todd. Well, and by the way, thanks, Todd, for inviting me. Ginger, I'm assuming you're out there. Thanks for inviting me back. Hopefully we can do something in person in Houston again with Red News and Real Estate Journal. But yeah, Todd, I think my comments from just a few minutes ago, the bulls are back. I just, if you look at the stock market and what's happened there, and the indexes are back above pre-COVID levels, there's a lot of liquidity in the market, tons of liquidity in the market. Mm-hmm. And what has been refreshing over the past year, and of course we do opportunity zone funds as well as tax deferred funds, the family offices are starting to get in the business. And we're starting to see high net worth individuals that are moving money even from the stock market into the real estate sector. And I think they're starting to realize some of the benefits of these long-term leases. And, real estate has had favored nation status under the tax code. Even back in '86, when they did the Tax Reform Act, they took some stuff away from us, but real estate has favored nation status in that tax code. And so it's a unique investment. And when you get in it and the tax attributes and the tax benefits, I think we're going to continue to see a flow of new capital from the retail sector. Forget about the institutional sector, but from the retail sector, be it individual investors over the next, certainly the remainder of this year. But I think that'll be a wave, as David mentioned, going into 21 and 22, just a whole new class of investors that want a piece of this action called real estate. So, we're excited about it. And again, happy to keep structuring the deals the way we have been and take advantage of the code.
I like it. Let's go, Cindy. Final comments.
Well, I mean, as far as this is a weird year, so the number of the deals, it definitely was not what we expected. The different types of deals that we're doing is more unique and different, but hopefully this picks up. And again, I also heard that the vaccine is coming out pretty soon. So that's light at the other end of the tunnel. I have been working from home ever since, and typically I'm so used to teaching classes and educating people in person. So I just can't wait to this to be all over and go back to normal and business as usual.
I'm glad you mentioned the vaccine again. I'm going to put in the chat room. This is where I track the vaccines almost every day. Click on that link. New York Times does a great rundown of every single vaccine and where they're at in trials. Kind of a neat deal. I think it's good to stay positive. I'm glad you guys brought that up because everybody wants to talk about more cases. I have 2 college students that are freshmen this year. They're both at home right now. That's not where college students belong. So let's kind of roll through this. David, you get to wrap us up. Take us home. Tell us anything we missed or any last minute comments.
Yeah, I don't think we missed a thing. The future's bright. We're moving forward on working with a number of tenants to increase occupancy in our portfolio. We've got a number of fund opportunities open and available, and we're looking to grow. I mean, we're expecting to be a couple billion within 5 years. So we think the buying opportunities are going to be robust over the next 18 months, and we're looking to capitalize on quite a number of those, whether it be with retail money or institutional money, and whether it be in one of our funds that exist today, ones that we're getting ready to open. So Texas is a great place to be. Houston in particular, I'm hearing great things about energy post 2020. Post 2021. You know, there's a lot of folks that think the next cycle begins at the beginning of 2022 in terms of energy and oil on the rise and in demand. If you think about it, 2014 was the great downturn this time around, and so it's already been 6 years into a downturn in the energy space. Once you see the economy open back up and gasoline sales increase and jet fuel increase and energy usage increase, I think you're going to see folks play catch up in the energy markets. It's not in many predictions right now, but look for it in 2022. You're going to see oil move dramatically upwards.
I think it's interesting that Houston's growing in spite of the energy, a 6-year downturn in the energy market. So yeah, I imagine in 2022, if we do get a boost there, it's going to be the hottest place on the planet, figuratively and.
Yep.
So this is a great panel. Hey, David and Dwayne, you guys really get it on the real estate side and putting investors in the right kind of products. Cindy, I'm super impressed with your knowledge of 1031 and exchanges and that marketplace. And I look forward to following your career in the future. Thanks, everyone. We're going to log off. Goodbye. Put anything you want to put in the chat room, last minute comments, or contact me or whatever. I will put this up on our YouTube channel, so you'll get to watch it again, get back some of the details that you might have missed. Feel free to reach out into these folks or me. You should have emails from all of us. So thank you, everybody. Have a wonderful Thursday afternoon, and let's go get out of COVID.
Thank you so much. Goodbye.